Richard, before we get started, I want you to tell us something that you believe about the legal side of real estate that might surprise us.
I think there are a handful of things. I'll start with just a purely a legal concept that impacts real estate, particularly syndications, and also talk about some of the practical aspects that dovetail with the legal nuances of real estate. And in terms of one of the legal principles that's fairly recently been enacted or become effective as of January 1st of 2024, impacts almost every real estate syndication involved. And it's legislation that was prompted from the Treasury Department to basically combat money laundering, trace the source of funds, and to remove a lot of the anonymity from where people are investing. And this obviously has a huge effect because a lot of investors like the anonymity of people not necessarily knowing where their money is. But basically, this legislation is called the Corporate Transparency Act, and it was actually technically enacted a couple years ago, but only became effective this year. And it requires owners, we'll use that nomenclature, that could be shareholders, that could be members of a particular entity, to basically enter into a federal database information about themselves. It can be their social security numbers, their addresses, some of the particulars about a deal. A lot of the information that you would anticipate putting on the know your customer disclosures that banks request. And this is basically going to be for any shareholders or members that own more than 25% of the entity. So this will be a bigger issue on maybe syndications that have less investors, where maybe their respective membership interests are larger. But they'll actually have to report all of that information. And there actually are penalties for not doing it. It's certainly not something that can be ignored because there are civil and criminal penalties for failing to comply. And so, from a criminal standpoint, you could be in prison for up to 2 years and or pay a fine of $10,000. And from a civil standpoint, you could have exposure of $500 for each day that the violation continues. Now, some of the other people that are going to have to report similar information would be your typical sponsor of a deal or someone who basically exerts substantial control over the project. And so that could be basically the manager that you would see for not necessarily the property manager, but more like the asset manager or the sponsor that are involved in a given project. They'll have to do these reports. And then basically company applicants, which would be somebody like myself, that basically direct the formation of the entities and the organizational documents and so on. I'll have to report as well. Now, it's a little bit of a headache doing that. The one good aspect is that there's basically within the Treasury Department, there's an entity called FinCEN, and it's the Financial Crimes Enforcement Network. FinCEN's a lot easier to say, but you can actually get a FinCEN ID so that if you have, like many of our clients, dozens and dozens of entities, if you basically change the information on your FinCEN profile, it will actually cross-pollinate or populate all of these other LLCs for which you might be the sponsor. And so that's good information to have. But in terms of some of the deadlines and timelines for this, so it became effective January 1st, 2024. Any entities that were formed before that date basically have a year to comply. So a lot of that time has already passed. So it's from this standpoint, it's almost like you have how many months left if we're in August now. So basically till December 31st of 2024 to get your information in. That's basically your period of grace to do that. For entities that are formed after January 1st, 2024, you basically have 90 days to basically maintain compliance and enter the data into the data system or the database. And then for any entities that are formed after January 1st, 2025, you're going to have 30 days to basically enter that information. The good news is it doesn't take terribly long to enter in the data that's required by the database. Um, and theoretically, once you've entered it once, you shouldn't necessarily have to do annual updates or annual filings unless some of that information has changed. And if that information is changed, then you basically have 30 days to enter whatever the updated information is that's changed um, in the system. So, as you can imagine, it's pretty wide sweeping. There are some exemptions to it. They're basically a list of 23 different types of entities that don't have to comply. And I would say the best rule of thumb with that is those tend to be entities that already have some level of reporting required anyway. You can think of financial institutions or anybody that's already regulated by the government that already has this information. A lot of those entities will appear on the list of exempt entities as well. But for a lot of your syndications, again, it's crazy because investors like to stay anonymous, but if they have over 25% or for sponsors of a deal or maybe their attorneys, um, there's going to be quite a bit of reporting that needs to occur, and of course there are penalties associated with that. So, so that's basically something legally new that's out there that has pretty far-reaching impacts. And the other thing I would say, and this is more of the practical tip that I see, having I've been practicing for about 2 dozen years, just shy of that, and met and dealt with and worked for all sorts of people. Some folks have been very above board and very particular about the details and have always wanted to document things correctly. And some people have played somewhat fast and loose and have had more of a mindset of if they shortchange, whether it's investors or providers, that it's worth whatever short-term gain there is. And I would generally say that for the most part, being above board and being transparent in all respects is really going to be the most beneficial in the long run. And actually taking the time to document the business terms correctly on the front end, not necessarily trying to cut expenses or go cheap, but making sure that you properly capture what the party's intent is in the paperwork. Because as we've seen through a lot of syndicators, maybe the last 18 months to 2 years, they followed a period where things were going pretty well. Uh, Valuations were going up, rents were rising, and so on. And now they've run into more trouble. You have higher interest rates, you have higher insurance costs, you have higher costs of maintenance, and sometimes it's difficult making those returns happen as contemplated. Um, but one of the takeaways, and to some folks it may seem counterintuitive, but memorializing everything on the front end correctly. But when things go sideways or aren't performing well, to be transparent and to maintain communication, even if it's not something that you're necessarily legally required to do in the documentation. Uh, your reputation tends to be your currency. And the more forthright you can be, particularly with investors, it definitely does build goodwill um, even if your asset or the project is underperforming. Um, so those are one of those things that people tend to discount oftentimes on the front end, and oftentimes they're very reluctant to obviously make mistakes or to admit they've made mistakes. But oftentimes that's how you become the best at what you do, and for your future projects, you learn from those mistakes, and it's one of those things that not everybody's going to have 100% success all of the time, but it's really how you learn from and handle those hiccups that are going to really build up and bolster your reputation um, down the road. And not being afraid to admit what you don't know and to surround yourself with people that are smarter than you or experts in certain areas because you'll learn more quickly. Surrounding yourself with a mentor will also minimize the expensive mistakes that you make as well. So documentation is key. It definitely gives you mechanisms for how to basically navigate certain pitfalls and issues as they arise. But there's a lot of common sense that goes and basically dovetails with following those provisions. Um, because again, your reputation is key and you're in it for the long term rather than the short term. So, somewhat of a long-winded answer, but those legally and practically are some of the things that don't always necessarily come to mind, that dovetail with the legal world as well.
Yeah, and that last thing you said is, I think, generally just great business advice that even if you have a deal that's struggling right now and it's easier to put your head in the sand and maybe avoid the truth, it will hopefully not be your last deal. And so even if this deal is struggling, there will hopefully be future deals, and your reputation is important on those future deals. Going back to the Corporate Transparency Act, do you remember offhand the name of that new document that is required to be filed with LLCs that that documents the owners of the entities?
So it is an online database. The acronym that FinCEN uses is BOSS, BOSS.
Mm-hmm.
And if you Google it, you'll quickly find the links to basically access that. And it is an online submission, and it will have fields for you to populate that information with. So we've been doing it for quite a few clients now to make sure they maintain compliance. And once we get the information from the client, if we don't have it already, um, it's been pretty user friendly. Um, the interface that we've had to use for that.
I see. Okay. Yep. So the document that I was thinking of was the beneficial ownership report. Does that sound familiar to you?
And that's very similar
Okay.
substantively to the know your customer forms that banks require. Um, so yes, the beneficial ownership is going to basically um, lay out all of the required information that they need.
And to be clear, this is so. I have experience with this newly because I typically create my all of my LLCs with a registered agent, and I do that for ease and then also anonymity to the public. I'm not trying to hide anything from the government, but I don't want my information out there publicly. And this act does not make and correct me if I'm wrong, but it does not make the ownership information public, but rather it puts it in the database for the government to be able to identify
That is
owners.
correct. That's a very good point. Yes, not it's not something where just anybody off the street can gain access to this information. It's to be maintained and held by the government officials only at the federal level.
Well, welcome to the source of commercial real estate, where we talk to the experts in commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. I am your host, Jonathan Hayek. I am a former public school teacher who found financial freedom through residential real estate investing, and now I invest in larger commercial properties, particularly small industrial properties. And we've already had an extensive conversation already, but today I am talking with Richard Crouch. Richard Crouch. He is principal and the business section chair at Woods Rogers, and he brings a wealth of experience and expertise to the real estate world. He has loads of experience in various types of real estate transactions like acquisitions, dispositions, leasing, development, financing. He regularly works with real estate firms and investors alike. Richard, thank you so much for joining me. How are you doing today?
I'm doing well. I appreciate you having me here.
Well, we've already had a fantastic discussion so far, but to continue the start of this discussion, why don't you tell us a little bit more about your background and how you ended up where you are today?
Okay. Well, I've been fortunate enough to actually work at the same firm ever since I graduated from law school. So I've been here, like I was saying, 23 years, almost 24 years. And I think a part of it, not only in addition to it being a great place to work, is I had two very good mentors when I first started working here. One was very good about the technical nuances in terms of legal expertise and to teach me what to be afraid of missing and what is important and principles like it's not simply what's in the document, but what's not in the document that you need to look out for. But my other mentor was excellent at basically teaching you everything they didn't teach you in law school in terms of how to attract, retain, manage clients, as well as to communicate with clients in terms of answering their questions, not wasting their time. And again, if you don't know, not being afraid to tell them that you don't know, but that you'll quickly get them the answer to it. So I was definitely blessed in that regard. And I think it's one of those things where those lessons in particular have translated well to me growing my own team and the younger attorneys in my firm. So, but the entire time, I have been a business attorney, primarily specializing in commercial real estate. And as you mentioned, pretty much if it touches on real estate, we handle it, including some of the more nuanced areas like historic tax credits and LIHTC and qualified opportunity zones, in addition to your standard acquisitions, dispositions, and refis. Um, so as well as land use and commercial leasing. So that's really where my experience has been, and and I've definitely enjoyed every minute of it.
Well, it's certainly been an interesting last few years in the world of commercial real estate. But here, as we stand in 2024, what sorts of areas of real estate do you find taking up the majority of your time and attention?
I would say since there are less syndications right now because interest rates are high and certain costs like insurance and maintenance are higher, um, we've been less focused on traditional acquisitions unless there may be self-funded deals. But those deals where you basically have a pool of investors and you form an LLC and structure it that way, we've seen less of that. Um, we have been doing a lot of work for clients where they've had maturity dates um, come up for their financing. And particularly for some of our office clients, in some of those cases, it's not something where they can easily refinance out of it for the reasons that I mentioned, or sometimes their valuation doesn't support the loan amount that they need. So they've been having to negotiate loan extensions and modifications with their lenders. And so a lot of that has been basically reviewing the loan modification documents, but oftentimes going back to the operating agreements for provisions like capital calls and capital contributions. And it is one of those things where at the beginning of a deal, it may not seem that important, but when it comes up for something like this, where they basically have to contribute capital to keep the asset viable um, and performing, it's nice to basically be able to look at the provisions and see that they're clearly laid out in terms of how our client basically approaches their investors and with a business plan and what is the contemplated amount for an additional capital contribution, and then to couple that with hopefully favorable lending terms to basically keep the asset performing rather than having to experience any forfeitures of any sort. So that's most of what we're seeing, and then we are seeing a number of land deals, but again, those are not the typical syndications that we've seen. Those are more issues where land is being redesigned for, say, a residential development or something along those lines, but not so much in the commercial space.
So it sounds like your time is being taken up with some of the difficult parts of real estate. A couple of years ago, things were going great. People were doing deals, buying deals, selling deals. Everyone's making money. Things are a little more difficult now. You mentioned office. And I want to ask you, and maybe you could even juxtapose it versus multifamily, because there's some multifamily deals that are struggling right now as well. But start with office. What the situation that you described, the total amount owed on the property does it's not worth that much anymore, and the office owner is in a difficult spot. They're trying to lease up space, but maybe having mixed results trying to lease up space. I'm guessing the lender doesn't want a big office building back. So talk to me about those situations and how are those situations getting worked out?
So for the most part, if it doesn't have to be 100% leased up, it certainly helps. But if it's relatively well leased up, they've usually been able to work out some extension under those terms, but sometimes it does require that they have gotten the additional capital to make everything work because the total amount of loan dollars are much more limited than they were, and so that's somewhat of the painful part. Um, so we are definitely seeing that. One other thing that we are starting to see more of, and this is more of an issue if certain borrowers technically have a default, whether it's failing to meet a debt service coverage ratio, but they're having to deal more with their servicers. And I heard servicers in the time I've practiced have never had a great reputation for being responsive or caring about what your issue is. Their focus is very limited to the criteria and the financial performance that's expected, and they have limited incentive to work with you in many cases. But we've had a lot of clients that have been trying to access reserves for tenant improvements, and if they're not coming to the table with completely clean hands in terms of uh, performance and defaults, it's made it very difficult for them to maintain the level of the asset that they need to and to keep their tenants happy. It's almost one of those things where they have doubled the number of issues because they're starting to have upset tenants and they're not able to access a lot of these reserves that have been in place as well. So we are actually starting to see some clients that are beginning to litigate with servicers as well to try to initiate some sort of performance on the servicer's behalf because that's an issue it's always been somewhat of an issue, but it seems to be particularly an issue now.
Sure, it sounds like maybe there are some carve outs in the original loan that the operator is not meeting, and they're not able to access those rehab dollars. But maybe that the servicer is also mad that the deal is not performing, and the operator is saying, "Well, it's not performing because I can't access these rehab dollars," and so it's sort of a vicious cycle. We've been hearing a lot in the multifamily world about capital calls and deals struggling. Do you have any part of advising your clients in what to do? We talked before about, we on the front end, we assume the deal is going to go great, and we don't always think about the capital calls and what happens when things don't go well. And so, do you have any part of advising your clients and when things are not going well?
Yeah, some of the things that tend to get discounted or overlooked, oftentimes they have to do with tracking performance once basically everything has commenced and things are not performing as well. And basically having certain mechanisms in place is very valuable down the road. So for example, with your sponsor or manager, whatever you want to call them, um, you do need to have certain mechanisms if they're not returns. It's one of these things where you'll see in a lot of operating agreements that there's almost absolute and plenary authority for the manager to make all business decisions of the asset. Some operating agreements are a little bit more balanced, where investors may have more rights in that regard. But you do need to have something in there where a manager can be removed for cause. And this actually really benefits both the manager and the investors because it actually injects a bit of specificity in terms of thresholds and benchmarks. You can basically say these are deemed to not be adequate from a performance standpoint, or these are items that can be for cause removal. And basically have certain things where if they haven't met a return for a certain number of fiscal quarters and they haven't submitted a business plan as to how to improve the situation, that by a certain percentage of a vote, the investors can have them replaced. It's very good to have that rather than have the ambiguity where investors aren't entirely sure what to do if the asset's not performing. And it also, in certain ways, protects the manager too, because they actually have at least a little bit more control over trying to improve the situation or at least maintain the optics of putting in all effort possible to maintain the asset and to continue to have it performing. Um, some of the other important things, mechanisms to have in there are exit strategies And that's another one because you're right. At the beginning of the deal, everybody's excited. The deal can't possibly lose. It's like falling off a
Yeah.
log. And then you're stuck in a situation where people are not, the dynamic is not quite as harmonious as it was at the beginning of the deal. And exit strategies can be one of those things that are specifically contemplated to occur on a certain date or upon a certain event, like a sale or refinance, or possibly a 1031 um, aspect to the deal. But you can have certain things that aren't necessarily as certain to occur, but also might create a situation where there needs to be language for how does a member basically disassociate themselves from the LLC um, and from the project smoothly and seamlessly. And so it can be issues where maybe there's a death or disability or a bankruptcy of a member or a manager, and having language saying, okay, what happens in that event in terms of how does a given member sell their membership interests? What are the restrictions on that? Um, and I would say probably the most common situation you see are ones where the asset hasn't performed as contemplated, and the member simply wants to disassociate itself, basically sell its membership interest. And what's the protocol for doing that? So usually you're going to see certain different ways to deal with that. Probably the most common one we see would be like a shotgun clause or a buy sell arrangement, where there basically are predetermined methodologies for valuing the membership interest, and usually they'll agree ahead of time as to who's going to make that determination. Sometimes you'll even see a formula for how it'll be determined, but there usually will be certain restrictions in place because existing investors as well as the manager are going to want to try to retain as much control as possible over the asset, and they're not going to want the membership interest necessarily being sold to miscellaneous third parties. So usually there is going to be some sort of right of first refusal for the company to buy the interest or for other members to buy their pro rata portion of the interest of the exiting member. And so having basically language along those lines is also very helpful and tends to make things smoother and less acrimonious, less litigious when you have basically mechanisms for how to address those issues.
Sounds like the theme is think about some of those worst case scenarios on the front end. Even if you think the deal is going to be a home run and everything's going to go great, think about some of those potential worst case scenarios on the front end, because at this point, once the deal is going south, I'm sure it's a much more difficult ball of wax to unwind at this point if you haven't thought about some of those worst case scenarios beforehand. Richard, I want to ask you about raising capital. And a couple of years ago, capital was flowing into real estate deals like wine. And as we talked about previously, nothing could possibly go wrong. I'm wondering if you're seeing in any with any of your clients, any of the deals right now, maybe any mistakes that were made previously. It seemed like everyone and their grandma was on social media raising capital, trying to get deals funded, and were a lot of times successful. Were there any, are any of those mistakes coming to light now that some of these deals are maybe not performing as contemplated?
I think, if anything, perhaps oversimplification by sponsors is become somewhat of their downfall now that they're struggling in the current market. A lot of things that are very important to include when they're raising equity is one, if you're going to be filing any sort of exemptions, like under Rule 506, for accredited investors or sophisticated investors, you need to thoroughly document that. You can't simply take their word for it. You also need to be careful as to who you're approaching. Rather than necessarily mass solicitations. The more information you can gather as a sponsor and document, the better. And so that's why you'll see things like subscription agreements that not only describe the deal, but they also have disclaimers and disclosures. I mean, they basically will say things like you could lose all of your investment in this deal. and making sure people are aware of that, but also disclosing any contemplated fees, whether it's an acquisition fee, disposition fee, et cetera, that the sponsor plans on taking as well. That's critical to include. Um, and then one of the other things that people tend to forget about, and again, this is one of those things where it falls to maybe the recesses of one's mind after the deal is closed, essentially, is if you are claiming an exemption, um, there is an online filing that's recommended that you do. That's relatively easy to do so, particularly once you've done it a few times. And that's the other one is you just want to make sure that everything is properly buttoned up because if things do go sideways, usually the same investors that had enough money to provide capital for your deal also have enough to pay on legal fees and so on if they want to allege any improprieties. So it's very much worth making sure that those exemption filings occur as well. Um, and I guess the last thing to say on that, in terms of gathering the information and making sure that you either have accredited investors or sophisticated investors, is there is an investor questionnaire that'll come along with the subscription agreement. Oftentimes it's an exhibit to that, that basically asks all of these questions to them to basically confirm the criteria for one of those categories. So it's just one of those things that best protects the sponsor as well when they're raising equity that again, oftentimes people are moving too quickly and don't really think about how these things can come back to bite them later. But those are just a few things that I recommend.
I want to ask a specific question about raising capital as debt versus equity. And this may sound like a selfish question, and it is partially selfish, but I think it will also pertain to a lot of listeners who might be in the beginning stages of raising capital, maybe from friends and family, or neighbors, or people at church, or whatever. And the difference being raise equity where there's a preferred return and there's upside. If the deal performs well, then there's additional upside. Whereas I typically structure my deals, I just work with my close friends, close family members, and I raise capital just as straight debt, where it doesn't matter how the deal performs. They just get a straight return, regardless of how well the deal performs. And so I would just like to hear from you if you have any thoughts on nuances and raising capital as debt versus equity.
Yeah, I think you've touched on some of the principles as well. I mean, oftentimes if you're coming at it from a lender's perspective, we'll just describe it that way. You're generally going to have less risk, and you're going to have pretty much a fixed. We'll just call it a fixed return. It's not a preferred
Uh-huh,
return, but it's a fixed
uh-huh.
amount that you will get based on capital that you're lending. Um, so from that standpoint, and usually you're going to have collateral, whether that's the form of having maybe a second deed of trust on the property or some other collateral that they're able to post to make you comfortable, you're going to have a secured position too, so that if they don't perform, you'll be able to levy on an actual asset to attempt to make yourself whole. So, but you are correct. I mean, the upside is more limited because you're not necessarily sharing in the performance of the property, and I think that's one of the appeals of the equity route in terms of getting maybe a more aggressive return with in exchange for a little bit more risk. I would say some of the other nuances are just the documentation that's involved. I mean, on that side, you're going to be seeing traditional loan documents like um, promissory notes, deeds of trust, possibly a pledge and security agreement. Whereas from the equity side, you basically are going to have a membership interest in an LLC, and you're going to have those standard governance documents like operating agreements that basically describe how the return is going to get paid and what the hierarchy of distributions is. Um, so you'll definitely see different types of documents on one side versus the other. Um, and then I would say the filings are different too. I mean, if now this is more from the sponsor's perspective, but for example, the Rule 506 filings, that's something you don't obviously don't have from the lender structured type of deal as well. So those are just some of the differences, and a lot of it is just based on the level of risk, and and some people are much more comfortable structuring it as debt rather than equity, just because it's more of a certain return in their mind.
Is structuring a deal, as you mentioned, with a promissory note and a deed of trust or mortgage, is that an acceptable way to structure a debt deal?
You absolutely can. One issue you might run into is if there is senior debt or the
Uh-huh.
primary mortgage lender, they may have restrictions in their loan documents that don't want there to be any sort of subordinate debt. That's particularly common in CMBS loan
Uh-huh.
documents. Um, there might be ways that you can structure it without taking a deed of trust as your collateral. And I say deed of trust to the listeners out there. In a lot of states, that's basically your mortgage instrument. That's just what they call it in Virginia and North Carolina, where I'm licensed to practice. Um, so that's typically how you would have that um, structured. Um, and forgive me, the second part of the question, it just slipped my mind
Yeah,
as I was.
yeah, no, that was great. It's just, is forming structuring deals with a deed of trust and promissory note, is that an acceptable way to structure debt deals? And I think you answered it.
Yeah, and the other part, the part that I left out was just if for some reason you can't put a second deed of trust on the real estate, you may be able to do mezzanine debt, where basically they're pledging their membership interest in the property owner LLC, and that can be your collateral. Not quite as good necessarily as having the real estate itself, but at least you're left with some recourse in the event that your borrower doesn't perform. But again, if there is senior debt involved, you're going to pretty much always be subject to that. So that's just one of those things you have to be mindful of and work it out with your borrower.
As we wrap up our discussion, any suggestions for the real estate investor or operator who is hesitant to get an attorney involved in a situation because they don't want to pay the fees, whether it's reviewing a purchase and sale agreement, looking over a lease, or working with passive investors or anything. Someone says, well, I don't want to pay an attorney. I can just handle this myself. Any suggestion for this person?
It's a pretty common narrative for sure. I would say it is definitely one of those cases where an ounce of prevention is worth more than a pound of cure. And a lot of referrals we get are once people are already in trouble and they're trying to get out of trouble. And so it is one of those things where it's worth doing it on the front end. I know I've said that several times, but it's just it keeps you out of trouble, and it can be hard for people to quantify risk avoided, um, and but it's definitely something that I recommend that you not go cheap on either. If you do get an attorney, please do not say, "Well, my cousin's a personal injury lawyer; he can do this just as well." Because then you can easily run in pitfalls too. You really want somebody not only that specializes in that practice area, but actually a great attorney to have is somebody who's also invested in real estate themselves too, because the business side does dovetail quite a bit with a lot of the legal principles, and you want somebody that truly understands all of that as well. So it's definitely worth dealing with a more sophisticated attorney, and you do get what you pay for.
And Richard, you talked about being licensed in Virginia and North Carolina. Are you available for consulting and business nationwide, or are you just limited to East Coast states? How does that work?
So typically, what we do, because we do have clients that buy assets all over, and so what we have to do, there are a lot of aspects that we can handle nationwide, but there are certain times where over the years, we've developed a good network of local attorneys. With whom we confer to check things like the deed and the recording taxes and any state specific nuances, whether it's in the purchase and sale agreement or the loan documents that the client is going to need to know about. And oftentimes, the lender involved is going to insist on that as well because they want to make sure everything's sound with their collateral as well. So, fortunately, within our firm, we have 19 different jurisdictions in which our attorneys are licensed. But for those states that are outside our firm, we over a couple dozen years have developed quite a few contacts that can handle those state specific nuances.
And Richard, if listeners hear this and they want to connect with you or connect with another attorney at Woods Rogers, where would you like to send people to get in touch?
Okay, probably the easiest way is my email address, and I'll say it, and then I'll
Mhm.
spell it out. It's richard.crouch at woodsrogers.com. And Richard is like it sounds, and then dot, and then Crouch is like crouching tiger. And then it's at Woods Rogers, and Woods is plural, and Rogers is plural.com. And I will actually give my mobile phone, and I will get this message, and I will get back to you quickly if you use that number, and that's 757-353-0969. Now, again, although I'm a business lawyer and do commercial real estate, any nuance that comes up, or whether it's a specialty within commercial real estate or some other legal need you have, our firm does handle it, so I can get you in the right direction.
Richard, this has been awesome. I certainly learned a lot. I'm grateful for your time. Thank you so much for joining me today.
Thank you again. It was my pleasure.
Listeners, if you enjoyed this conversation, feel free to reach out to either one of us. We love talking about real estate and we would love to connect with you. We appreciate you listening. Make sure you come back next week for another great interview. Thank you so much for listening. Until next time, take care.